What is your tax plan? If you don't think you have one, chances are you've got a government plan. In this video, I'm going to explain to you how you can move towards the 0% tax bracket and save literally hundreds of thousands of dollars just during retirement in unnecessary taxes. So stay with me and I'll explain to you what you can do to reduce your tax liability. My mission is simple, to help you protect your family and keep more of your money. I'm here to help level the playing field for families and those who seek the truth. There's always a new way to make money, but at the end of the day, it's your family's security and your legacy that matter. And I promise to help you protect what's really important to you. Legacy money starts now. With all the recent government spending, you just have to ask yourself, where is the government going to get all of that money? Remember, the government can create revenue in only two ways. They can increase taxes, they can increase inflation. And to compound the issue, the IRS is hiring thousands of new agents. Now this has some people scared, but you don't have to be. Fortunately, there is a better way, and it doesn't require hiring a CPA or a tax attorney. If you want to pay as little in income taxes as possible, you need a tax strategy. Deferring taxes in your IRA or 401k isn't a viable option. You're only postponing the inevitable. And what if tax rates go up? But even if you do have a government plan now, there are steps you can take to reduce your tax burden in the future. Look, I know all the TV and radio entertainers have told you to max out your contributions to your tax deferred plan, your 401k, IRA, SEP, 403b, and the like. But just like most traditional advice about personal finance, it's hogwash. While they've told you that your money will compound tax deferred, and when you retire, you'll have more money to spend. What they don't tell you is, if your money does actually grow, as your money compounds, so does your tax liability. And if tax rates go up, so does your tax burden. You don't have to take my word for it. Even the Society of Actuaries says, if tax rates stay the same, it makes no difference if you pay the taxes now or you pay them later. Most people look at their investment accounts and they see them growing each year. But what they don't realize is they're probably growing because of the contributions they've made. But even if you have increased your account value despite the volatility and the fees, then you still have a problem with this account. The taxes will be due. Many people have forgotten that all of the money in these accounts is not theirs. The IRS let you defer the taxes for all of those years, and they will get paid. You'll owe taxes on every penny that you've put into the account, what your employer may have matched, and on the growth of the money. It's hard to believe that after you've taken all the risk, the tax collector can swoop in and take 40% or more of your account value. Now just think about that for a minute. If you've got $1 million and you're in a 40% bracket, that's $400,000 that is the government's, the IRS, only leaving you $600,000. And what if rates increase? What if inflation eats into the value of your investment? And it could be worse if you die and your family or spouse has to pay those taxes. Let me give you a bird's eye view of how you can pay and even reduce those taxes, and how you can move towards a 0% tax bracket during your retirement. Let me explain something. You will have to pay taxes on the distributions from these tax deferred accounts. There's no way around them. However, you can take pennies today and leverage them into dollars tomorrow. And the strategy that I'm going to share with you can ease your tax burden, so you pay the least amount possible, which can literally save you hundreds of thousands of dollars. You see, the government has specifically given you an out. This is not some loophole or complicated backdoor plan to avoid paying taxes. And it's not a risky crypto investment in a self-directed IRA where taxes will still be due. But these strategies can help you reduce your tax burden, pay your taxes with leveraged dollars, and move you closer to a 0% bracket. And depending on your age and health, you can take advantage of this tried and true tax strategy that's been used for centuries by those in the know. This tax strategy can facilitate the safe distribution of your hard-earned money when you retire. But if you don't start planning now, you could wind up paying even more taxes. Many people are surprised to discover that their retirement plan could cause up to 85% of their Social Security benefits to be taxed. Unfortunately, financial planners and CPAs today are seeing their retirees' tax bills increase dramatically because of this tax. Okay, so here is the untold secret to help you move towards a 0% tax bracket and reduce your tax liability during retirement. You're going to need a place to store your capital that offers tax benefits and income options. This tax strategy is available to you if you plan now, because you do have to qualify health-wise. I'm talking about good old-fashioned dividend-paying whole life insurance. Now, in case you don't qualify medically, you still have other options. So you'll want to see what you qualify for by getting a financial review. The tax advantages of a properly structured life insurance retirement plan include: this tax strategy can be built around your specific goals. You can leverage pennies today to buy dollars for tomorrow. There are high contribution limits and options for tax-exempt income. There are no required minimum distributions, RMDs, that might push you into a higher tax bracket. You contribute after-tax money, therefore no more taxes are due, even on the growth, as long as you follow a few simple rules. And if you're concerned that tax rates will go higher, then you need to pay your taxes now, while taxes are still on sale. Any income or distributions you take from this account are not subject to the IRS provisional income that can tax your Social Security. The income you take doesn't increase your Medicare premiums, unlike IRA distributions. The cash value and the death benefit grow guaranteed. You have the potential to receive dividends on top of the already guaranteed growth in the contract. And there's a 150 plus year track record of paying these dividends every single year. You have access to the capital at any time for any reason, including things like long-term care. Worst case scenario, you pass and your family receives the death benefit income tax free. If you have taxes that are due, they can use the benefit to pay the taxes. There you have it, a tax strategy to reduce your risk and have your dollars work harder. And it's completely legal, spelled out in section 7702 of the IRS tax code. You don't have to let taxes get you down. All you have to do is take a look at where you are today and decide if you want to do anything. You can get an idea of what the taxes will be on your IRA and what taxes will look like for your family. It can get pretty ugly. You'll probably get to a point where you'll wonder how you're going to pay these taxes. I don't know how you're going to pay them other than with your investments or savings itself. I don't know how to pay them any other way. I don't know how anybody would. So instead of worrying about your future tax liability, you can put in place a tax strategy today to protect you and your family in the future. You can find out what you can do to reduce your tax liability in the future. And you can do it by getting a complimentary financial review. And you can decide if this is a viable strategy for you before you have to make any hard decisions. What do you have to lose? You can only gain by reducing your tax liability and protecting yourself from unnecessary taxes. So thanks for watching today. Let me know if I can help you. Go ahead and smash that subscribe button, and I'll look forward to seeing you in the next video.